Let's break that down, right? So let's do a quick exercise to break down the NAV of Cheung. So let's say real estate development is like approximately 26% of the NAV. Investment properties, these are cash flow generating. Remember, right? These are about 17% of the NAV. Listed investments, which is predominantly Hutchison, it's about 56%. 54% of the NAV, right? So that's roughly, the company. So, and as I said, the Hutchison part is actually growing faster than the real estate development parts, right? So the proportion of NAV coming from Hutchison should increase over time. And that's actually a plus because remember, there are some concerns about potential real estate slowdown in Hong Kong and China. So that's also a hedge, right? So I think it makes a lot of sense to actually, reduce the percentage of your asset base coming from the real estate, if, for example, interest rate go up or the market slow down, right? But even, I think if you look at the real estate market right now, I think a lot of the, if you look at development pipeline, for example, right? I think 2014, and already management has mentioned that will be they'll hit the record in terms of total number of completion. For a lot of these real estate companies, you can only book the revenue when you complete the project, right? Because previously you collect the money first, right? Because these are pre-sales, right? So you got the cash, but you haven't recognized any earnings. So this year and next year, they try to book the earnings, and you can only do that by completing the projects, right? And in terms of, I think, well, Hong Kong is still a very substantial part of the, NAV, right? Within the 26%, I think about half of that is from Hong Kong development. Despite a lot of talks about the I think, very high real estate prices here, let me give you some basic, statistics so you appreciate how fundamentally, distorted the market in terms of demand supply. Average, household formation per year is about 40,000, meaning new couples getting married, right? 40,000. And extra 20,000 is actually coming from divorces. Think about this, right? When two people separate, one of them need an extra house, extra place to live, right? So that will create, let's say, 10,000 units of demand, right? So that's about 50,000, the 40 plus the 10, right? And then you have people who want to invest in real estate, that kind of thing, right? So roughly speaking, let's say, 60,000. The total supply of flat this year, according to government, is only 15,000. So you look at the demand supply imbalance, you can figure out, right? I mean, people can, of course, they can defer their purchases. You can stay with parents, but only for so long. So I think, the market, there's still pent-up demand for real estate, maybe not as priced as high as before, but remember, the remaining assets, they bake into a 70% discount to the book value, not NAV, book value, right? What is book value? The book value is, the price you pay to acquire the land, the historical cost of, buildings, that's book value, right? In terms of the investment properties, right? These are cash flow generating, fully financed, right? These completed projects, right? Offices, shopping malls, hotels, right? True, there may be some move up or down in terms of the NAV, but inherently these are cash flow generating assets.